Hi guys, I hope you all are doing well. Welcome to the session. So this is our second day of the performance management revision session. And in this session, what we are going to be doing is we shall be covering the variance analysis. In the first session, we went through the decision making questions. So we'll be talking about the variance analysis in the today's session and we'll take things forward. Again, my approach is going to be, I will go through the latest examination questions that have been published by the ACCA on their CB practice platform, and we would just do those questions and take things forward. So let's just start off. Um, okay, the question that I'm going to start off is basically March, June 2021. So March, June 2021. So March, June 2021 is the relevant examination through which we are actually going to start off with. Now, let's just start off discussing about it. So basically, in this specific scenario, the requirements that are there is one of them is it says calculate the market size and the market share. Explain why the businesses calculate the market size and the market share variance. That's one thing that they have actually asked for. The second thing is that they've actually asked for calculate the total market size, which is the planning variance, and the total market share, which is the operational variance for MTC for quarter two. So they've asked you to calculate the sales, the market size, which is the planning variance, and the market share, which is the operational variance. Now, if I move a bit forward, the third requirement is discuss the actions of the sales director at cheat company and how this may have impacted the variances and how this may have impacted the variances. So that's what he has actually asked you for. So we are going to start off and we would start discussing about these, that how exactly are you going to be doing these specific questions. Just allow me a minute, please. Okay, so let's just start off. Let's just start discussing about these market size and the market share variance and all that. So let's have a bit of a discussion about this. The first thing that I want to talk about is when we are going to be calculating these variances, there are a few things that I want to discuss with respect to variances. What are those few things? The number one of them is, you know, that the variances could actually be calculated for the cost and they could be calculated for sales also. When we try to calculate the variances for the cost, so the different variances include material variances, different variances include the labor variances, the overheads, whether that be the fixed overhead, whether that be the variable overheads. And when we talk about the sales variances, so sales variances is like whatever the sales that happen. And basically there are two types of majorly the sales variances that exist. And what are those two type of sales variances that exist? One of them is called sales price variance. The other one of them is called sales volume profit variance. So with respect to the sales, there are two types of the variances that actually exist. One of them is called sales price variance. The other one of them is called sales volume profit variance. Now, so in this specific scenario, the examiner has specifically talked about the sales variances. So I would be explaining and I would be discussing the sales variances and then we would take things forward. So now let's talk, if we talk about the sales variances, what exactly are the different type of sales variances? So one of them is the sales price variance. What is the sales price variance? It is actually the variance that is arising because of the differences in the sales price. When we talk about the sales price variance, how do we establish the sales price variance? It is actually the actual selling price minus the standard selling price multiply by actual sales quantity. Now let's try to understand. Let's try to see that what exactly is it. So if I say actual selling price, let's say you have been able to sell the goods at $20. The standard selling price was $18. And the actual sales quantity that has been there is 200,000 units. The actual sales quantity is 200,000 units. So what's going to happen is that if the actual sales quantity is 200,000 units, so you'd say that this 200,000 multiplied by 2 gives you $400,000 as the favorable sales variance. As the favorable sales variance. So when I talk about the sales price variance, the sales price variance is the benefit, is the advantage that you get from the sales price that you charge. Is the advantage, is the benefit that you get from the sales price that you charge. That is going to be termed as sales price variance. Now let's move a bit forward and let's discuss further. So what about the sales volume profit variance? The formula for calculation of the sales volume profit variance is that actual sales quantity minus budgeted sales quantity multiply by standard profit per unit. Multiply by standard profit per unit. Now, how would we go about it? How would we do it? So basically, when it comes to the sales volume profit variance, when it comes to the sales volume profit variance, how would we go about it? See, you would say, let's say the actual sales quantity is 200,000 units and the budgeted sales quantity was 215,000 units. And if your standard profit per unit is, let's say, $3, so resultingly you would have $45,000 as an adverse variance. Why is it going to be adverse variance? Because the actual quantity was 200, the budgeted quantity was 215. So there was actually a adverse amount of 45,000 unit that has arisen. So the adverse quantity of 45,000 multiplied by 3 per unit, which is actually going to give you $45,000 adverse variance. So we have got what? We have got one of them, which is called the sales price variance. The other one of them is sales volume profit variance. Now, I'll move forward and I'll discuss further another concept, and that is basically the concept of planning and operational variances. Now, what exactly do you mean by planning and operational variances? So let's say for example, um, you have a sales volume variance of 45,000 adverse. Now you got to see that why has this variance actually arisen? So there could be multiple reasons for the variances to arise. And amongst the multiple reasons, one of the reasons could be because of the changes in the market conditions. The other one of them could be manager's performance. So let's say, for example, because there is a change in the market condition and the market has actually deteriorated significantly, because what has happened is that the demand for the product has gone down. It's not just us, it's like every single competitor is also struggling, not just us. When that is such thing happen, so you would say that okay, uh, that means if we had actually budgeted to sell 215,000 unit, the revised budget for the market, revised budget considering the market condition would mean that we should only sell 180,000 units. So basically, you could see that this is one of those variants that is arising because the budget has actually been revised. So this variance is called planning variance because there is a change to the planning. There is a change to the planning. It is called planning variance. And then similarly, what happens is that let's say that actual sales is 200,000 unit. So now we had revised the budget to be 180,000. We managed to sell 200,000. So this 20,000 extra that you have been able to sell, this is actually the operational variance. This has happened because of the manager's performance. So it's like controllable. It's like manager's performance. So when you talk about the planning and the operational variances, the planning variances is the variance that arises because of the changes to the original plan. So whenever there are changes to the original plan, we have got what? Planning variance. And then we have got the operational variance. How does this operational variance arise? So with respect to the operational variance, this actually arises because of due to performance of entity. So due to the performance of the entity, the variance that actually arises, that is going to be considered as the operational variance. What is it going to be considered as? It is going to be considered as your operational variance. Now, let's move a bit forward and let's discuss further. So basically, when it comes to the sales, these variances are also given another name. And the game that is given is basically this is called market size variance. And this is called market share variance. So generally what happens is that the market size variance is, as I said, it's a planning variance. It is out of control of management. Market share variance is basically an operational variance. Within manager's control. Within manager's control. So what is actually the question's requirement in here? It says discuss the actions of sales director at cheat company and how this may have impacted the, sorry, not this, sorry. Question number 4. Let's just go through not even question 4, question 5 is what we have to go about. Okay, see, sorry, medical temp company. The question's requirement is that this part of the scenario relates to the requirements A and B. Medical temp company is one of the several agencies in Psychtopia supplying medical staff, both nurses and doctors, under temporary weekly contracts to local hospitals. So what does it do? It actually supplies to the local hospitals. That's what it does. So what happens is that is one of the several agencies in Psychtopia supplying medical staff, both nurses and doctors, under temporary weekly contracts to local hospitals. Information regarding the size of the market in Psychtopia for the supply of medical staff is as follows. Quarter number 1, quarter number 2. Supply of national market The size of national market for supply of temporary nurses, $14 million. Quarter one, quarter two. Size of national market for supply of temporary doctors is this and this respectively. Now it says the increase in the national market for the supply of temporary nurses is due to a shortage of full-time nurses. So basically, the supply of temporary nurses is due to a shortage of full-time nurses. All agencies in Sectopia, including MTC, charge a single market rate of supply of each staff 1,000 per week for supplying a nurse and 2,000 per week for supplying a doctor. In quarter one, MTC held 30% of the market for the supply of temporary nurses and 40% for the supply of temporary doctors. MTC uses quarterly rolling budgets. At the end of quarter one, it prepared its budget revenue figures for quarter two. It based these budgets on the assumption that company would continue to maintain market share it had in quarter one. It also assumed that it would maintain its standard contribution margin of 80% for both nurses and doctors. Actual figures were this. Total revenue from supply of nurses, total revenue from supply of doctors, actual contribution margin for both nurses and doctors. Now requirement is that why businesses calculate the market size and the market share variance, that is something that you have to talk about. So what is going to be the answer to part A? Just think about it's a 4-mark requirement. Just think about writing down the 4 pointers. Okay. See, what is going to happen is that you need to understand this thing. That basically market size, I'm just writing down 3 pointers, but in the examination, you don't write down the pointers, you write short paragraphs. I'm writing down the pointers to help you understand. Market size and market share variance are a breakup of the sales volume variance. Every organization wants to increase its sales. When compared to the budgeted quantity and the actual quantity, the difference is about the sales volume variance. These variances could arise due to either the changes in the market conditions or due to poor performance on the part of management. If the combined sales volume variance is either favorable or adverse, the reason for it is to be analyzed further to evaluate whether controllable factors were not managed properly or if to evaluate whether the controllable factors if the combined sales volume is either favorable or adverse, the reason for it is to be analyzed further to evaluate whether controllable factors are managed well or not. So the market size variance is actually a planning variance which suggests that which suggests that how changes in the market has impacted the budgets and the demand levels. Market share variance, they are operational variances and compare the performance of the entity and compares the performance of the entity with the revised budget to see how managers' performances have impacted the volume. So it's good to analyze it because then you can make a proper assessment as to whether the management has done well or management has not done well. So it is important to identify this. I bet it is important to identify these because to have an evaluation of whether the management has done well or management has not done well. Right? Okay, let's move a bit forward and let's move further. Now the requirement is that you have to calculate the market size, which is the planning variance, and the market share operational variance for MTC for quarter two. So you need to understand that how do we actually calculate the market size and the market share variance. So I told you that the market size variance is going to be on the basis of the original plan compared to the revised plan. And the market share variance is going to be the actual versus the revised plan. Okay, now let's just try to see this. It's a 10 mark requirement and we have to just do things like this. So it is going to be calculated. We have to do it for quarter number two. You have to do it separately for nurses and you have to do separately for doctors. The first thing is that planning variance, which is the size of the national market for supply of temporary so and so, so and so. All agencies in Cyctopia, including MTC, charge a single market rate for supply of each type of staff, 1,000 per week for supplying a nurse, and 2,000 per week for supplying a doctor. In quarter one, MTC held 30% of the market for supply of temporary nurses. Budgeted market share held 30% of the supply of nurses and 40% of the supply of doctors. So budgeted sales is like this into this, is like this into this. So there's a budgeted sales that is actually being given. I mean, there's a budgeted sales that is being given. In fact, budgeted sales has to be on the basis of the quarter one and on the basis of quarter number one. That's what the budgeted sales have to be. So you are being given the budgeted sales. And it says that it had a standard contribution. It was 80%. It was 80%. So budgeted contribution is gonna be 4.2 into 80%. 3.36 million, 2.56 million. So this is going to be budgeted standard contribution. So what have we been able to do? We know that it was expected to be what? Based on quarter number one. So we have estimated that, okay, the budgeted contribution is this. The budgeted sales are this. Things like that. The actual figures for quarter two are as follows. Total revenue from supply of nurses is this. Total revenue from supply of doctors is this. Actual contribution margin is this. Now what do we need to do? We need to actually establish the revised budget. We have to establish the revised budget now. How would we establish the revised budget now? We would do it like this. So it's like 18.9. It's like 8.2. Budget share is 30%, 40%. Revised budgeted sales. Revised budgeted contribution is this. So basically what happens is that there is a revised budget. Okay. So you have got what? You have been able to establish that what should have been the original budget, and you have been able to establish what should have been the revised budget. So if we talk about the calculation of the material size variance, which is the material planning variance, so how do we actually go about it? We would do it like this. Sales planning variance, which is market size variance, is gonna be 4.536 minus 3.36 into 10 raised to power 6. So it is like favorable variance. It is favorable variance. Now, before I move on to the next one, can you just please go through it and let me know that you understand this? Yeah, can you just go through it and let me know if you understand this, please? So you would say total market size variance is gonna be this plus this favorable. Yeah, please let me know if you understand this, please.
So please, for the planning variance, the market size for nurses, you used 14, that is for quarter one, rather than that for quarter two,
Okay,
18.9.
let me just guide
I'd
you.
like
See
to know
here it
why.
mentions in the question. Here it mentions in the question
I don't
empty.
understand why you.
Okay, let me just explain to you. See, in quarter number one, MTC held 30% market supply for nurses and 40% for doctors. You understand this? Now, at the end of year quarter one, it prepared its budgeted revenue figures for quarter two. It based these budgeted figures on the assumption company would continue to maintain the market share it had in quarter one. Now, this is the important line. So here the examiner is mentioning us in this line, the one that I've highlighted blue. That's the relevant thing. In fact, I would just highlighted something else. Right? Do you understand now? Do you understand now?
Yes, sir.
Okay, let's move. Now, next is basically we have been able to. Okay, where is the difference, Robin Rogers? Let me know where is the difference you have. In what area are you having a difference? Okay, you got 128,000 favorable for doctors. How did you get it? It's like, have you got the original budgeted contribution? Because you see here it is going to be sales, volume, contribution variance. That's what you would calculate. Because otherwise, if it's a profit variance, but in this scenario, it's going to be sales, volume, contribution variance. That's what you would calculate. Sales volume, contribution variance. That's what you would calculate. Okay, let's move a bit forward and let's take things forward. So basically now we have got what? We have got the revised budgeted contribution. So now what we need to do is that we need to calculate the market share variance. Market share variance is also the operational variance. How would you calculate this market share variance? You would compare the revised budgeted, okay, actual contribution compared with revised budgeted contribution. Okay, so the doctors, nurses. What is the revised budgeted contribution? It was this. Now, in order to calculate the actual contribution, it says total revenue from supply of nurses is 5.3 million. So it is gonna be 5.3 million multiplied by 75%. It is gonna be 3.6 million multiplied by 75%. So the variance is gonna be this minus this and this minus this. The market share variance is gonna be this plus this. This is adverse. $485,000 adverse. In fact, wait a bit. Wait a bit. We have to do a bit of a change. The actual sales has to be because we are not calculating the profit variance. We are calculating the volume variance. So it has to be at 8 million. So 40,000 adverse is the market share variance. Total market size, total volume, total sales volume, contribution, variance will be as under. It will be 1,240,000 plus 40,000, so 1.2 million. Okay. Now, so this is what we have got, the total sales volume contribution variance. Is that okay now? Is that okay now? What have I done? I've said that actual standard contribution. Actual standard contribution. What is it? It is actual standard contribution, right? Actual standard contribution. Now, let's move a bit forward and let's talk about the last requirement of the question, which is basically discuss the actions of the sales director at cheat company and how this may have impacted the variances which have been calculated. So can you just review this area and can you just try to see what is happening? Okay. It says with respect to cheat company, the market size and market share variances have also been calculated for Q2 for one of the MTC's competitors. Now, cheat company, these variances are as follows. So the details for nurses, details for doctors, the total details are given, the market size variances, market share variances. Size variances are adverse, share variances are favorable. Cheat company holds the same percentage. Okay. Cheat company holds the same percentage of each market as MTC. It also uses rolling budget and prepares its budgeted revenue figures using exactly the same assumptions as MTC. However, when cheat company sales director had to provide the market size figures for Q2 to the accounts department, he deliberately reported these figures 30% lower by excluding the market segment relating to maternity units. The accounts department were unaware of this. Now, just one thing that you need to discuss the actions of the sales director at cheat company and how this may have impacted the variances which have been calculated. Okay, see what happens is that uh, see these companies, what they have got is that cheat company holds same percentage of each market as MTC. It is also using rolling budget and prepares its budgeted revenue figures using exactly the same assumptions as MTC. However, when cheat company sales director had to provide the market size for Q2 to the accounts department, he deliberately reported these figures 30% lower by excluding the market segment. Okay. The director is manipulating figures. He is not reporting the available information completely. The impact of not reporting leads to lower budgets slash targets being set. Hence, there is a chance to be able to achieve better performances and reflect a favorable market share variance. Now, by understating the market by 30%, this would mean that the revised budgeted contributions will be 30% lower, and hence this would reflect favorably in the market share variances. So the fact that if you actually deliberately change the variances, this is going to be an issue. So instead of the share variances to be very highly adverse. The share variances would turn out to be favorable, and he will take advantage of this performance. Right? So that's what is going to happen. I bet that is what is going to happen. Is that okay to all? Okay, so we are done with this specific question. The name of the question was basically, in fact, it was cheat company. That was the question that we did. Cheat company's question is what we actually went through. Okay, next I have got a March June 2023 question, and I'll do that. Okay, so we have got a March June 2023, and this specific question, the name of this question is Wagon Company. It actually has got multiple requirements. You could see that first part, all of the requirements are of 3, 3, 3, 3, 3. So there is this 12 mark requirements and all pertaining to different variances on material. Then what do we have? Then there is this assessment of the performance of both production manager and purchasing manager, which is of 8 marks. So let me just take you people through, and let's just see that what exactly is this all about? How exactly are we going to solve this scenario? So let's just try to see this. Okay. Okay, let's just start off. So we need to first now understand the material variances. I bet we need to understand the material variances. Now, when we talk about the material variances, there are things that I want you to understand, which is basically that whenever we talk about the material variances majorly arise because of two things. One of them is the material price variance. The other one of them is the material usage variance. I bet one of them is a material price variance. The other one of them is a material usage variance. How do we establish the material price variance? How do we establish material usage variance? So material price variance is established like this. Standard price minus actual price multiplied by actual quantity. When we talk about the material usage variance, the usage variance is basically usage variance is standard quantity minus actual quantity multiplied by standard rate. Usage variance is standard quantity minus actual quantity multiplied by standard rate. Now, so basically what happens is that, let's say your standard price is $3 per unit minus the actual price is 3.5 and the actual quantity is 10,000 units. So it is going to be an adverse variance of $5,000. Similarly, let's say you had to, whatever the production that you did, you had to use 12,000 unit, but you actually used 10,000 unit. The standard rate was 3, so this is going to be 6,000 favorable. So material price and the material usage variance, the price variance actually tells you that what is the difference in the price that has arisen, and the usage variance actually tells you that to what extent has the usage been favorable or adverse. Now these price and usage variances could further be categorized into price planning variance and price operational variance. So the planning variance is basically going to be so original standard price minus the revised standard price into actual quantity, and the operational variances is going to be so this is how it is going to be. I repeat, this is how it is all going to be. Now let's try to understand and let's try to see that how things are. So if I try to apply this whole into this scenario, the wagon company, I'll give you some 5 minutes if you could just go through this scenario and see what information you can gather. See what information you can gather out of this. Okay, now let's see. So what actually happens is that it says Wagon Company is based in Zealand and manufactures a wide range of non-meat and non-dairy products which it supplies to its retailer. Its mission is to produce high quality, cruelty-free products sourced from local ingredients. Wagon uses a just-in-time system and holds no inventories. Its best-selling product is soya milk, and for the month of November, production levels were as follows. So budgeted production level is 440,000. Actual production level is 480,000. The main ingredients used in soya milk are soya beans and sugar, both of which are grown within 50 kilometers of Wagon Company's premises. Wagon Company markets its soya milk on this basis, making it appeal to customers committed to caring for the environment. What does Wagon Company do? They market the soya milk on this basis, making it appeal to customers committed to caring for the environment. Extract from the standard cost card per unit of soya milk for November are shown below. Quantity is given, cost per kg is given. Now it says Wagon used 94,000 kg of this, 5 to 8 kg of this in its actual production of soya milk in November. The actual cost to Wagon of soya beans was this, and the actual cost of sugar was this. Market price has decreased by 10% in November, but for sugar it increased by 20%. This was due to usually cooler winter, which had a positive effect on soybean crops but a negative impact on sugar crops. Purchasing manager is responsible for negotiating price with suppliers. Wagon Company made a change to the standard mix at the beginning of November, reducing sugar to 10 grams per unit in order to comply with the new government legislation. To try to maintain the consistency of the milk, Wagon also decreased the soya beans and so on. So none of the above changes to the price and quantities are reflected in the standard cost card for November, which is prepared by accounts department and updated twice a year despite both purchasing and production manager is stating that it is not frequent enough. Now, first of all, we would try to calculate the material price planning variance. How do you establish the material price planning variance? You would say the standard price the actual price So I've just created, we have got two products. So there's this soya bean. There's this sugar. Now, if I talk about this, the standard price for soya bean is 5.9, is 1.8 for this. um, it says market price of soya bean has decreased by 10%. This into 90%. And the price has increased by 20%, this into 1.2. So price variance per unit is going to be standard price minus this actual price. The actual quantity that has been published, 94,000 kg of soya bean, 5280 kg of sugar, so hence the variance is going to be this into this and this. So this is like favorable, this is adverse, total material price planning variance is gonna be how much? Is gonna be this plus this, 53559. Okay. Now this was material price planning variance. I'll just copy this again, and now I would say this is the material price operational variance. The revised standard price is gonna be 5.31, 2.16. The actual price is gonna be what? 5.7, 1.9. So the actual price, the total material price operational variance is this. Price operational variance is 35,287 as an adverse variance. Right? So we have been able to do the material price planning variance and the material price operational variance. Now the next one of them is material usage planning variance. I'm just copying this so that I can just make the amendments. Always recommended to create a format once. Usage planning variance. How do you create this? You say the original standard quantity, revised standard quantity, quantity variance per unit, standard. This is actually gonna be what? This is gonna be the standard. What would you do? You would say that this is actually gonna be what? This is actually gonna be the standard price. See what happens now. Just try to understand this. Let me just guide you a bit. That basically, okay, so you have got the original standard quantity, which we are probably gonna put in here, and then you have got the revised standard quantity. Then this is gonna be the quantity variance per unit. And then what would you have? You would have what? Standard. See, it's like the usage planning variance. We are trying to establish that what is gonna be the usage. So we'll say standard price per unit. It should be based on the original standard price per unit. So you will end up getting the total material usage planning variance, right? So what are you gonna get? You're gonna get total material usage planning variance. right? This is what we have. This is what we have now. So you understand this? Now I've just created a structure. Sorry, yeah, standard price per kg. Standard price per kg is what you have to actually mention. Now let's try to understand this. Basically, let's say Wagon used 94,000 kg of soybeans and 5 to 8 kg. How much was the original standard? It was like 0.2 kg, 0.2 kg, right? Is he mentioning somewhere that how many units did we produce? Is he mentioning? Yes. Budgeted production level and the actual production level is given. So original standard quantity is the actual production level of 480,000 multiply by soybeans is like 0.2 per 0.2 kg multiply 0.2. Whereas you have got this to be 480,000 multiply by 0.012. How much do you get? 5760, right? That's what it has to be. This is the original standard quantity. What's gonna be the revised quantity? I'll just copy the formula here. I'll just paste it here. Okay, I'll just copy the formula here and I'll just paste it here. The same formula here and I'll paste it here also. So basically, what's the revised standard quantity? It's like, just a second, please. Okay, see, you have to basically what happens is that you have to use the standard because you see, whatever the actual production was done, we have to calculate the quantity on that basis, na? Whatever the actual production was done, we have to use the quantity on that basis. It always has to be on the basis of actual production. Now, what happens is that reducing sugar to 10 grams per unit uh, to try to maintain consistency, Wagon made change to the standard mix at beginning of November, reducing sugar to 10 grams. To try to maintain consistency of milk, Wagon also decreased soybean contents to 190 grams at the same time. Okay, So it's like 0.19 and this is like 0.0010. So this is what it is going to be. Then what is the original standard price per kg? It's like 5.9, 1.8. So you would have the variance to be this is how things are gonna be. Right? So this is total material usage planning variance. Now I'm just copying this whole and I'm just gonna put it here. And now this is material usage operational variance. This is what we have to calculate now. So when you talk about the operational variance, you would say revised standard quantity and the actual quantity. Okay, the actual quantity is 94,000 kg here, 5280 kg here. The standard price is like this, so it's like adverse and the adverse. So we have been able to calculate the material usage planning variance also. If I could just sum up the whole of this, so you'd realize this thing that the four variances that we had, there was material price planning variance, there was material price operational variance, there was material usage planning variance, there was material usage operational variance. That's how things actually were. I bet that's how things actually were. Right? So now this was part A of the question. If you have got any questions on this, whatever that I've done, do let me know, or else I move on to the next part of the question. If there's any question that you have, do let me know, or else I move on to the next part of the question. Okay, let's move. So the next part of the question is assess the performance of both the production manager and the purchasing manager for the month of November. I could just mention here, which is the material price planning variance is 53,559 favorable. Material price operational variance is 35,287 adverse. Material usage planning variance is 30,048 favorable. Material usage operational variance is 17,384 adverse. Now, actually use my scratch pad to take the notings because that was on another screen and I could just not follow what is happening. So I just use my scratch pad to take some of the notings. I don't know if I can copy from here to here. I don't think so. I can. Okay, lovely. Makes things easy for me. Okay. Now what is he asking? What is he saying? Let's try to see. It says the purchasing manager is responsible for negotiating the prices with the suppliers. So that's the responsibility of the purchasing manager. There's this purchasing and the production managers both are available. Performance of both production and the purchasing manager for the month of November. Now, the total material price variance is $18,263 favorable, 53,550 minus 35,287. However, without looking into the details, the purchasing managers performance would seem to be contributing towards this favorable variance. However, upon analysis, it is identified that the variance is arising because of the planning changes due to reduction in the material prices in the market. Despite the fact that the prices in the market have gone down, wagon purchasing manager has still bought materials at expensive prices, leading to a variance of 35,287 adverse. You would actually do a similar type of analysis for the usage variance also, and it would be on the basis of production manager. So usage variance would be for the production manager. Let me know if you understand this. Usage variance would be on the basis of production manager. It will be on the basis of production manager. Right? You get it? Yeah, do you get it? Okay, price variance can affect, but you see here what happens is that the price variance is already negative. It's already adverse. That means he has not actually compromised on the quality of the product. If the price variance would have been favorable, then we would have said that it has impacted it. But it's not the case here, right? So we are done with this question also. That was about the wagon company, and that was also covering variances. So we are done with the variance revision also, and I hope that you people would have enjoyed it. So thank you very much for being here. Thank you for your time. Inshallah, see you again for the next session tomorrow or day after.